Hi friends, TCS announced its Q4 and fiscal year 2024 results last Friday, April 12th, after the markets closed. Since then, the stock has declined by 3.3% this week. This drop raises the question, is the decrease a direct response to the quarterly results or is it influenced by the overall market sentiment? This past week, the Nifty fell by 1.1% and the Nifty IT index dropped by 4.2% in just 2 days. Factors such as the conflict in the Middle East, recent inflation data from the US, and the potential postponement of interest rate cuts by the US Federal Reserve have all contributed to the market's current pessimism. Interestingly, when the market opened on Monday, TCS initially rose by 1.7% before declining sharply as the overall market mood soared. This leads us to wonder whether TCS stock price will recover as the market stabilizes and whether the Q4 results are actually viewed positively by analysts and investors. We'll explore these questions further in this video. First, let us do a deep dive into the quarterly and yearly results for TCS and understand what went well and what fell short of analysts' expectations. The net profit of TCS rose by 12% quarter over quarter from 11,058 crores in Q3 to 12,434 crores, significantly surpassing analysts' average growth expectations of 3.2%. The 12,434 crores of Q4 consolidated net profit was up 9% from the profit Rs 11,392 crores in the Q4 of fiscal year 2023. Analysts were expecting a 5 to 6% year-over-year profit growth in Q4. Profits surpassed expectations due to an impressive operating margin of 26%, exceeding the 25.2% analysts had anticipated. This was a rise of 150 basis points or 1.5% over the 24.5% operating margin recorded in Q4 of fiscal year 2023, the previous fiscal year. The net profit margin was 20.3%, up by 100 basis points over 19.3% reported for Q4 of previous fiscal year. The quarter saw a strong deal momentum, resulting in an order book that is bigger than any other year in the history of the company. The total contract value or TCV for the quarter was $13.2 billion. This set a new record of highest ever order book for a quarter in the history of TCS. Compare this to Q3 fiscal year 2024 order book of $8.1 billion and you see a significant increase of 63% quarter over quarter. The Q4 fiscal year 2023 order book was $10 billion and hence registering a growth of 32% year over year for the company in Q4 of fiscal year 2024. This brought the full year TCV to an all-time high of $42.7 billion. Compare this to the TCV of $34.1 billion in fiscal year 2023, a 25% increase this year. The surge in new deals indicates the potential for stronger revenue growth in the upcoming quarters. This, in my opinion, is the highlight of the quarterly report. Some analysts have predicted that the current order book can lead to double-digit growth returning in fiscal year 2025. K. Krithivasan, CEO and MD TCS said, "We are very pleased ending fiscal year 2024 on a strong note with the highest ever order book and a 26% operating margin, validating the robustness of our business model and execution excellence." Before we discuss further positives, let's address the disappointments in this report. The revenues grew by a modest 1.1% quarter over quarter, reaching Rs 61,237 crores from Rs 60,583 crores in Q3. This growth was below the expected 1.4%, making it one of the report's letdowns. The firm reported a 3.5% year-over-year increase in its revenue at Rs 61,237 crores from Rs 59,162 crores in Q4 of fiscal year 2023, despite ongoing demand weakness. Compare this growth to what TCS had reported last year in April for Q4 fiscal year 2023, a staggering 16.9% year-over-year increase in revenue. The constant currency revenue grew by a modest 2.2% year over year. The constant currency growth of revenue reported a year ago for Q4 fiscal year 2023 was 10.7%. The whole year rupee revenue for fiscal year 2024 was Rs 2.41 lakh crores, growth of 6.8% over fiscal year 2023. Last year and fiscal year 2023, the company had seen a growth of 17.5% in its revenue over fiscal year 2022. The banking, financial services and insurance or BFSI sector continued to show weakness in quarter 4 with a 3.2% shrinkage in revenue share as compared with quarter 3 of fiscal year 2024. BFSI is the largest vertical for TCS and other IT companies like Infosys. Krithivasan, the CEO, said, "We are seeing weakness in the BFSI sector nearing its bottom, which suggests that a revival could be on the cards. But it's too early to say if we are there yet." In fiscal year 2024, the revenue growth was driven by the energy, resources and utilities sector, which saw an increase of 12.6%, followed by manufacturing at 7.3% and life sciences and healthcare at 4.8%. However, the revenue shares of these sectors remain much smaller compared to BFSI. For instance, despite strong growth, the energy, resources and utilities sector only contributed 5.6% to total revenue, while BFSI, which experienced a 1% decline in revenue compared to fiscal year 2023, still accounted for 32% of the revenue in fiscal year 2024. In fiscal year 2024, revenue from the UK saw a significant increase of 10.1%. Additionally, revenue from regional markets experienced a substantial jump of 19.8%, although their contribution to the total revenue remains relatively small at about 12%. The revenue share from North America is the biggest area of concern since it's currently at 50% and it's showing a decline. Over the entire year, revenue growth from this region decreased by 0.2%. More specifically, there was a 2.6% year-over-year drop in quarterly revenue in quarter 4 fiscal year 2024 compared to quarter 4 of fiscal year 2023. Now let us revisit some of the other positives in the quarterly report. The book-to-bill ratio for the quarter was 1.8x, indicating a healthy demand for their services and a steady flow of work. The book-to-bill is the ratio of value of orders received to value of products or services delivered and billed. The 1.8x ratio suggests that there is sufficient work to keep existing employees busy and may also provide the opportunity to hire additional staff. The trailing 12 months or TTM book-to-bill ratio stood at 1.5x. So for every dollar of services delivered and billed in the past year, TCS received $1.50 in new orders. Again, it shows that the company is successfully expanding its client base and securing more business than it completes in a given period. This is essential for long-term sustainability and growth. Another of those positive numbers to come out of this quarterly report, the free cash flow. The free cash flow for fiscal year 2024 was Rs 44,282 crores, up 6.9% from fiscal year 2023, indicating improved financial health and operational efficiency. Also, cash flow from operations was at 100.4% of the net profit. This implies that profits of the firm are not just realized on paper, but it's being converted into actual cash by the firm. Cash that can be utilized for reinvestment, paying dividends, reducing debt, or other purposes. These positive financial indicators show that the company is performing strongly in its operations and finances, but facing challenges in the broader macro environment. For the first time in nearly 2 decades, TCS saw a decline in its headcount for the third consecutive quarter. By the end of fiscal year 2024, the total number of employees had dropped to 6,01,546, a significant shift from TCS' historical trend of steady growth in headcount. On a year-on-year basis, TCS workforce decreased by 13,249 with a reduction of 1,759 employees in quarter 4. This downturn is in sharp contrast to fiscal year 2023 when TCS added 22,600 employees, raising its total to 6,14,795 employees. Despite these reductions, TCS continues to actively recruit freshers on campuses. In the preceding financial year 2023-24, TCS had set a target of onboarding 40,000 freshers. Recently, TCS announced it would start its second hiring phase later this month, planning to hire 10,000 fresh graduates. Prior to the earnings call, several pressing questions were on our minds. What are the future growth prospects for the firm? Can IT firms bounce back from the recent lows? Will the IT index see an upward movement? These were the questions uppermost on our minds. TCS, however, did not offer revenue growth guidance for fiscal year 2025 and beyond. Krithivasan, however, did say that fiscal year 2025 should be a better year, even though it's too early to call by when stronger growth returns. The company's earnings call took place against the backdrop of Accenture, the world's largest IT services provider, reducing its fiscal year 2024 growth forecast from the initially projected 2.5% to 1.3% on March 21st. This adjustment indicated ongoing weakness in the overall business of IT service providers. For more detailed discussion on revival of IT sector in fiscal year 2025, check my video on Infosys where I discuss in detail Bank of America Securities' positive spin on revival of IT sector in fiscal year 2025. Much of the discussion in that video about Infosys and its growth prospects is relevant to TCS as well. In fact, many of the reasons provided by Bank of America for its upgrade of Infosys should apply to TCS as well. The link to the video is in the description below. Meanwhile, investors will now look forward to Infosys Q4 results scheduled to be announced tomorrow on April 18th to gauge the IT sector's recovery status. So as investors, the question that is uppermost in our mind is, what is the impact of Q4 results on the stock price? Will it go up in the near term? Let us see what analysts say. Several brokerage firms have increased their target prices for the stock following what was seen as a strong performance in the Q4 by TCS. Global brokerage JP Morgan has upgraded TCS to an overweight rating. It increased the target price to Rs 4,500, noting operating and net profit margins that beat market expectations. The brokerage felt TCS is set to outperform competitors in fiscal year 2025 with record high order book and a book-to-bill ratio of 1.5x over the past 12 months. Additionally, TCS AI pipeline has grown to $900 million, doubling from the previous period, which the brokerage views as promising. Meanwhile, Goldman Sachs holds a buy rating on TCS. It has set a target price of Rs 4,350. It saw a strong potential for double-digit earnings growth in fiscal year 2025. It has reiterated its forecast for 8% revenue growth for TCS this fiscal year, a significant increase from the 3.5% growth reported in fiscal year 2024. Morgan Stanley has kept its overweight rating on TCS. It did say, though, that the management provided limited insights on near-term revenue growth prospects and that could potentially affect the stock price. However, they pointed out that a strong exit margin at the end of fiscal year 2024 sets a more optimistic outlook for fiscal year 2025. The brokerage has set a price target of Rs 4,350 for TCS. Meanwhile, domestic brokerage Kotak Equities has raised its target price on TCS from Rs 4,140 to Rs 4,300. Kotak said this adjustment was due to impressive execution and effective cost management by TCS. Kotak said, "We expect TCS to lead peers on the revenue growth in fiscal year 2025, aided by contribution from BSNL and as other mega deals ramp up. Clients remain focused on cost takeout initiatives, an area of strength for TCS, enabling it to gain wallet share against weaker peers, leveraging its broad range of service offerings and diversified presence across verticals and geographies." Analysts at Motilal Oswal have decided to largely maintain their earnings per share or EPS estimates for TCS for fiscal year 2025 and 26. They have also chosen to stick with their target price of Rs 4,600 for the stock. Echoing a similar optimistic outlook as JP Morgan, Swiss banking giant UBS anticipates that the TCS will outperform its peers in terms of revenue growth and achieve better margins in the financial year 2025. UBS has given TCS a buy rating with a price target of Rs 4,700. However, UBS did note that despite positive outcomes in the March quarter, TCS management has been reserved about declaring a growth revival. The firm pointed out that management is being careful because there are risks of deals being delayed or slipping through, especially with uncertain macroeconomic conditions. Nevertheless, UBS expressed confidence in the eventual revenue generation from recent deal wins, stating that the conversion of deal wins into revenue is a matter of time. Additionally, HSBC also favors TCS, citing its sector-leading earnings resilience. It has maintained a buy recommendation with a price target of Rs 4,540, underscoring continued confidence in the company's performance. Global investment bank Jefferies has maintained a hold rating on TCS and has set a target price of Rs 4,030. The firm acknowledged that TCS fourth quarter results exceeded expectations. However, Jefferies cautioned that ongoing demand pressures could dampen future growth prospects. Despite a robust deal pipeline, the management's conservative outlook, combined with ongoing headcount reductions and a significant decrease in subcontractor use, have raised concerns. Jefferies also noted that the current premium valuation of TCS shares leaves limited potential for an increase in the stock price. Chinese investment bank CLSA has maintained an underweight rating on TCS following the March quarter results. It has lowered the target price to Rs 3,941 from Rs 4,043 previously. The firm cited delayed macroeconomic revival and a lack of management confidence as key factors that might hinder the stock's near-term recovery. Additionally, the CLSA reduced its earnings per share or EPS estimates for fiscal year 2025-26 by up to 2.5%. This brings us to the end of this video. So friends, hope this video was helpful to you. We will see you in the next video. Thanks for watching. Have a great day.